Welcome. Today we'll learn 3 classic chart patterns: head and shoulders, triangles, and flags. These patterns are a picture of how big money, institutions, funds, the same flows that move the S&P 500 tends to buy and sell. Once you can read them, you get a clearer sense of when buying pressure is building and when selling pressure is taking over. Trading on patterns alone can be dangerous. Historically, plenty of textbook setups fail. Reliability tends to rise a lot when volume, trend, and time all line up with the pattern. We'll cover the idea behind each pattern, then look for how they can show up on the Bitcoin daily chart on your screen, the same shapes traders watch on index charts when the Fed is shifting the mood. Check whether your own chart is flashing a similar signal. Ready to start? A head and shoulders pattern is a warning that an uptrend may be running out of steam. It's 3 peaks: left shoulder, head, right shoulder, shaped a bit like a person's shoulders and head. The left shoulder rises first. Then the head pushes higher than that shoulder. The right shoulder stalls a bit below the left shoulder's height. The imaginary line connecting the lows under both shoulders is the neckline. Think of it as support. The price level buyers keep defending, the same way a round number like $100 often acts as a floor on a stock. A break of the neckline means buyers can no longer hold the line, and a deeper decline often follows. Look for a recent 3-peak shape on the chart in front of you. The measured target is simple. Take the distance from the head down to the neckline, then project that same distance below the neckline. That's the classic measured move estimate, not a promise. The biggest beginner mistake is jumping in the moment a pattern looks like it might be forming. While the right shoulder is still building, you can't know it's a real head and shoulders. It could be a flag or just a bounce. Wait for a candle that clearly breaks the neckline, a close below it. That is the confirmation candle. And if price climbs back up to the neckline and gets rejected as resistance, you get a second check that the sell signal is real. Traders call that a retest. Waiting a few extra days costs almost nothing next to the damage of a bad early entry. Patience is the best risk management, whether you're trading Bitcoin or watching USUG names after a Fed decision. There are 3 main triangles: ascending, descending, and symmetrical. An ascending triangle has a flat ceiling and a rising floor. Buyers keep stepping up, often a setup that resolves with a break higher. A descending triangle is the mirror image, a falling ceiling and a flat floor. Selling pressure is building, so a break lower is the more common resolution. What every triangle shares is shrinking volatility, the market catching its breath. A bigger move often follows. Try framing the current sideways range on this chart as a triangle. A breakout on thin volume can be a fake out. Always check volume at the break. The same rule applies when the S&P 500 squeezes into a tight range before a big Fed week. A flag is a short rest inside a strong trend. It looks like a small flag sitting on top of a flagpole, that sharp surge or plunge. In an uptrend, the flag is a pullback. Price raced higher, paused to catch its breath, then often resumes higher. Think of it as a pit stop, not a U-turn. In a downtrend, the flag is a bounce. Price dumped hard, bounced briefly, then often continues lower, a rest stop on the way down. Timing matters most. Flags usually resolve within about 1 to 3 weeks. Stretch much longer, and you're probably looking at a different pattern or plain sideways chop. Flags are continuation patterns. If the breakout volume is roughly in line with a flagpole's volume, the original trend has a better chance of continuing. The same idea traders apply on dollar price stocks and index futures. All 3 patterns share one ingredient: volume, the total amount traded over a given period. Neckline breaks on a head and shoulders, triangle breakouts, flag continuations, Each signal is far more trustworthy when volume expands with it. A few people can't start a riot. A crowd can. High volume means more participants are aligning in one direction. Price moving without volume is a weaker signal. As a rough rule of thumb, many chart analysts look for about 1.5 times the 20-day average volume at the signal moment. That 1.5 times figure is experience-based, not a law. Adjust it for the asset and the market regime, especially when Fed-driven volatility is elevating baseline volume. Volume profile, or a simple volume indicator, can sharpen the read. Check the volume bars under the pattern on this chart. The three patterns we covered today are signals chart analysts have cited for roughly 100 years, on stocks, indexes, and now crypto. Some argue that AI trading and more efficient markets have made classic patterns less reliable than they used to be. Always pair them with your own backtesting and risk management. The key rule: wait for the confirmation candle. A few days of patience is cheap insurance against big losses. Waiting for support or resistance to be retested is the core habit. Place stops beyond the pattern's opposite extreme and size targets using the pattern's measure height. Then adjust your own risk-reward ratio, whether the move is measured in dollars on a stock or points on the S&P 500. This lesson is for education only. Every trade decision and its outcome are yours. Backtest thoroughly and verify for yourself before risking real money.